We have two more sessions here. We've got one virtual with Luke Gromen, who's a macro fund manager. This is our third installment of my investor fireside chats, and then I'm really excited to have Colleen Sullivan from BH Digital, who just led our Series B, to chat with me about her favorite themes and brands in gaming for the next couple of years. So without further ado, we will bring in Luke. There he is. Luke, sorry we couldn't get you here in person, but definitely appreciate you joining us virtually. I know you had a good excuse for the travel switcheroo, but I think as macro fund managers go, you've had some of the best writing about the macro situation and kind of where crypto, Bitcoin in particular, kind of fits into that equation. I know we have a few slides that you'd presented that kind of tells this macro story. But maybe just for a starting point, do you want to give people a sense for, if you can do this in like a minute or two, like your general kind of state of what's going on in macro kind of worldwide, and how you've kind of come to Bitcoin as one of the assets to keep an eye on in light of what's going on with interest rates, with central banks' behaviors, and then with the supply chain overlays and kind of geopolitical tensions that are rising is all this. If we could do a 60-second version, then we'll elaborate on that for kind of the duration of the session.
Sure, and I touch on this a bit in the slides, I guess, as well. It's a great segue. So thanks for having me. I appreciate it. I apologize to everybody. I can't be there in person. The 60-second version of it is that we have our first bursting global sovereign debt bubble in 100 years. We have a peak cheap energy crisis that has, in the last 8 months, I guess more like 5 months, been exacerbated by what has happened in Russia and Ukraine. It puts, we also have demographic issues that are adding to the debt problem by virtue of pulling, in particularly in the West, off balance sheet entitlements onto balance sheet. And central banks are either going to have to choose, and governments and other policymakers choose to default on their obligations in some fashion, or print the difference. And our view is that print the difference is most likely, but that they'll probably try to pretend for periods of time that they're actually going to not do that. And year to date in 2022 has been one of those times where they are doing a very good play of pretending that they're not ultimately going to have to print the difference. So I think Bitcoin in particular, I think neutral reserve assets do really well in that system. As they try to prevent debt from defaulting, in particular sovereign debt from defaulting. So I think Bitcoin does really well. Other neutral assets as well that I would throw gold, I'd throw energy into that as well.
Once people get into crypto full-time, they get an honorary degree in macroeconomics and kind of armchair economics, as you know. So you're speaking to an expert class of armchair economists here. But let's assume for a second that you know a little bit more than most folks in this room just based on your background. Why don't we go into some of the slides? And I think it's helpful to get the real backdrop here and some of the drivers of your thesis for the next couple of years. So I'm not sure who's driving the slides. There we go. So
I should be there it is. So we just go to the first one. There's only 3, so I'm going to be quick to everyone in the audience, which I would also say okay, so big gears. We had talked about what are the big gears driving macro. First global sovereign debt bubble bursting in 100 years. So basically, if you go back to 2000, we had a tech and internet bubble. It burst. Paul Krugman, Paul McCulley recommended, hey, let's create a housing bubble to replace the demand lost, the aggregate demand lost in the economy when the stock bubble burst. So effectively, the stock bubble, when it burst, was kicked upstairs to the U.S. banking system by virtue of creating a housing bubble. As we all know, that burst in 2008. That bubble then was that burst was kicked upstairs to the sovereign level by virtue of sovereigns basically backstopping most of everything that needed to be backstopped by growing their balance sheets. Now, in the aftermath of COVID in particular, there's nowhere else to kick the problem up to. They either have to allow sovereign obligations to begin to default, or they have to begin basically fully, policymakers and central bankers have to begin fully reserving sovereign debt. And when that sounds very fancy, fully reserving sovereign debt, that just means buying more of it on there and putting it on their balance sheet, which is what they've been doing at an accelerating pace up until this year. The second driver to all of this that is problematic is peak cheap energy. Peak cheap energy does not mean we're running out of energy. It means we are empirically no longer able to grow our energy supplies that we need to grow them in order to grow the economy, in order to sustain the debt that we took on that's at record levels. We need more energy. The problem is, to get more energy, you need the price of energy to rise. The problem with that is that getting energy prices to rise by enough to generate enough supplies takes inflation up too high to levels that make the bond market unhappy. And so then you run this vicious cycle of, we need more energy to sustain the debt. We need more price increases in energy to get that energy. Those price increases drive inflation. That inflation drive rates up. Those rates going up makes the debt less sustainable. Wash, rinse, repeat until either the debt collapses, or more likely, as we said before, central banks step in, print money, and more fully reserve sovereign debt to prevent sovereign debt defaults and defaults on things like entitlements, defense spending, et cetera. That brings us to the third point, which is U.S. entitlement pay-goes. Those are just what the government spends every year on entitlements. It's about $2.9 trillion this year alone, roughly 70% of all-time record tax receipts. When you add Treasury spending to that number, you're at roughly 100% of tax receipts, and tax receipts are at an all-time high. After we had an everything bubble in 2021, not surprisingly, we had a tax receipt bubble in April 2022. They were up almost 40% year over year. Those tax receipts are now rolling over. And so we hear frequently this conversation about zombie companies where EBITDA is below 1 time in terms of interest expense, right? Their cash flows aren't covering their interest. If you add U.S. entitlement pay-goes, which are basically the interest on the off-balance sheet stuff for entitlements, and Treasury spending, which is basically your interest expense, the U.S. government is a zombie. Its tax receipts are not covering its real interest expense, which is problematic because the U.S. government issues the global reserve currency. And so through that global reserve currency, it affects everything. And what this ultimately means then, as you can see in point 4, something we've been saying for about the past 4 or 5 months, is that Powell seems to think, and has reportedly been said, that he thinks his choice is to be another Arthur Burns when letting inflation go in the 70s, or another Paul Volcker and be the hero for stamping out inflation in the early 80s. And the reality is the debt position of the United States, the demographic position, the financialization, the interest rate sensitivity of the United States couldn't be more different than under Volcker. And what that means is that his choice are actually being Arthur Burns, which is letting inflation run hot for a sustained period of time, or being Ben Strong, who was the Fed chair in the late 20s, who over-tightened rates and tightened the world into the Great Depression. And so year to date, he's chosen to be Ben Strong, and he chose it again this week. So that takes us to the third slide in terms of how does this end, and then we can dive into and take this in any direction you want to see. You'll frequently hear from macro people, well, the U.S. is just going to be Japan. If you go to the third slide, there's a picture's worth 1,000 words. Or excuse me, sorry, second slide. I jumped ahead. The reason why his choice is not Volcker, but rather Burns or Strong, is because of this vortex. So foreign central banks, it says foreigners at the top, it's foreign central banks, as you can see in the flow chart itself. U.S. deficits go up, U.S. has to borrow more money, foreign central banks aren't buying enough treasuries yet or anymore. Fed's no longer doing QE anymore. And so the U.S. basically begins crowding out global dollar markets. That takes you down to the 6 o'clock position on the flow chart. U.S. federal borrowing is secularly rising by a significant percentage of private sector income growth. So you start crowding out dollar markets. You get dollar up, you get treasury yields up, you get short-term rates up, all of which we've been seeing. As that happens, you go to the 9 o'clock position on the chart, and stronger dollar, higher rates starts to slow the economy, increase U.S. deficits. You go back to the 12 o'clock. You wash, rinse, repeat until the system either collapses or the Fed steps in and basically is forced back into a version of what it did from 2020 to 2021, which is helicopter money. And so now if we go to slide 3, the final slide, and then we can jump off. You frequently hear from a lot of macro people, the U.S. is just going to beat Japan. Well, the blue line is the Bank of Japan's balance sheet as a percent of GDP on a 10-year lead to the Feds. The red line is the Feds as a percent of GDP. So that's where this game is going. And importantly, there's no the euro dollar market of significant offshore dollar borrowings. There's really not a very big euro yen market. So in theory, a lot of those Eurodollar debts may end up on the Fed's balance sheet by the time all is said and done as well. So ultimately, that red line is going to follow the blue line. But until it does, unfortunately, we're in for probably more pain. Basically, the beatings will continue until morale improves going forward. So I'll stop there. So, like I said, it's a 3-slide presentation on some of the big years that we can jump off and touch on more from that point.
Well, I remember the debt sequester back in like 2011. I think that was the first time that I'd ever heard of Bitcoin. And basically, this was the first of many times that Congress was dysfunctional enough to just hold a gun to each other's head and threaten across-the-board cuts. They didn't end up going through with it. They pushed the debt debate anyway. And it was the first time that that S&P had ever downgraded the U.S. debt, right? So I remember looking at charts like this in 2011 and 2012 and 2013 when I came back to Bitcoin for the first time. And basically every single year, this is kind of like at my bedside table. This is the nighttime story that I tell myself in the bear market to convince myself that I didn't make a catastrophic error in judgment by not selling the top. But the reality is these governments and central banks can stay irrational for a lot longer than these theses can ultimately take to play out. So when you think about the timing here, you mentioned that the Fed has signaled that they are going to be aggressive to curb inflation. There's still talk of a soft landing. There's denial of whether we're even in a recession. There's a little bit of head in the sand on the emergence of kind of great power rivalry and what's going on with China and Taiwan, and obviously in the Ukraine. When does this come to a head, or you don't have a crystal ball, but is there a time frame and like a confidence interval that you have for when the Fed is going to have to reverse course because there's breakdowns in the Treasury market, and that's going to create this ripple effect that leads to some of these inflationary events, and ultimately is good for some of these commodity assets like Bitcoin?
I think we're going to see it in the fourth quarter this year. I've been on record saying I thought the Fed would cease raising rates after the end of the third quarter of 2022. And I wrote that in April. And people thought it was nuts then. A lot of people still think I'm nuts. But when you talk about things that you can see in markets, first thing you would see as this plays out is the dollar would go to the moon. The dollar will rise against everything inexorably, and it will start breaking everything. And that's happening. The next thing you'll start to see, and this is the thing that I think people have been most skeptical about, is the dollar will break the Treasury market. As things get weak, there will be a great degree of confusion as to why, unlike every other recession, every other crisis in everybody's career over the last 40 years, why is the 10-year Treasury selling off? Why are yields going up when the dollar's going up when we're heading towards a recession? This doesn't make sense. And yet here we are. And so when I see things like today where the TLT, or the U.S. long-dated Treasury bond, after Powell comes out on what's today, Thursday, so he came out yesterday and said he's going to be really tough, and he knocked the stock market down 500 points, and he's going to keep going until he gets it done. And today the U.S. Treasury bond was down 3%, 3% on the TLT. That's an enormous move in the quote-unquote deepest, most liquid market in the world. And ultimately, more the dollar goes up, foreigners own $7 trillion in treasuries. The Japanese own $1.4 trillion in treasuries. They came out and intervened in the yen last night. if an intervention in the yen knocks the Treasury market down 3%, it's not going to take too many. What happened when the Europeans start selling? What happens in Japanese, Chinese? There's 7 trillion more to go there. The Fed's selling 95 billion a month in theory. And as we go into a recession, Treasury is going to have to upsize the amount of Treasury selling. And so you've got this massive sell side and constrained bank balance sheets, et cetera. So all by way of saying, I think we are in the end game now. I think what we're seeing in the dollar in terms of the end game of a Fed pivot, what the dollar's doing, what it's doing to our allies. I mean, when we're, it's ironic is when we come out in a great power competition against China and Russia and say, we need to win this. And then the first thing the Fed does is strengthen the dollar and basically destroy Europe and destroy Japan. I mean, it would be like us going into World War II and 1940, hey, Britain saying, we need your help. And we go over, we bomb Britain, and then we go and kill every single member of the French resistance and go, oh, there we go. I mean, that's literally what the Fed's doing right now. So the dollar strength and the teetering in the Treasury market, the weakness in the Treasury market, I think we're going to see some fireworks here in the fourth quarter. I think we've started to see fireworks already, but was it Bachman Turner overdrive? You ain't seen nothing yet.
When will people catch on to this, right? I mean, you're contrarian right now in your call for the Q4 for QE to make a return, and you've articulated the case, and I think you've been banging the drum on this for a couple of quarters now. But if you are proven right, and it is Q4 or Q1 of next year that we start to see this change in policy, when do you think people start waking up to the commodity trades, and in particular like crypto as one of the commodity money trades that might be an inflationary hedge? Because I think the folks that have talked about Bitcoin as an inflation hedge, myself included, we've always thought about it in the context of central bank and QE, not necessarily what price changes are. And critics will accuse us of moving the goalposts, but this seems like we're getting to the final go, no go on whether this whole thesis that many of us have had is actually going to be viable, and this is going to prove to be a resilient defensive asset. Are others starting to come into this trade, or are they just totally taking the other side of the bet that you have, and they'll be scrambling to find that hedge or that right trade in Q4, in Q1 when it's already kind of surrounding them?
I think there's a greater recognition of, but it's still small, right? Like I had a friend of one of my best relationships in the business, a macro trader. He goes, Luke, the Eurodollar futures for April are 4.98% or something. He goes, the U.S. government's out of business at 4.98%. People aren't doing the math, and right now it's just all about the dollar, right? Hey, I'm short the euro, I'm short the yen, I'm long the dollar. It's working great, and so we're in a business, especially fast-moving markets, volatile markets, highly political markets, geopolitics. We're in a business where people don't think a lot about the second derivative in normal times, let alone in these times. And I think we're getting close. I think as you continue to see, if you continue to see treasuries sell off, long-dated treasuries sell off, as the economy slows. And I think if you continue to see gold first not go down and then start rising despite rising real rates and rising nominals, and I think I would throw Bitcoin in there as well. If you see Bitcoin and gold stop going down as yields and treasuries keep rising, that's going to be your tell where people are starting to put that trade on of, hey, I'm doing the math and the U.S. government's out of business at 4.98%, where everyone's saying terminal rate hikes are at this point.
Luke, I think I listened to a podcast with you a couple of months ago, maybe even sooner, where you said the best case scenario was to let inflation run into the mid double digits for a couple of years, wash things out of the system. And you said it very casually. It was disarming when I heard it. I had to rewind it. Could you just articulate like exactly what you think the optimal path is? Because this is the most contrarian take that I've seen in the markets. But the way that you've articulated, I can't help but agree or believe that it's at least possible, if not the probability, is high.
Yeah, look, Reinhart and Rogoff, Reinhart's, I think, the World Bank president now, or a chief economist of the World Bank. Rogoff was the chief economist of IMF. They did sovereign debt work 10 years ago. And a guy named Brian Hirschman did some interesting breaking down of the data. The punchline is this. Once you get a country to 130% debt to GDP, like the US was in summer 2020, like Japan's been for a while, Europe, I think, is close if they're not already there. Anyway, going back 220 years, 98% of those countries that hit 138% or 130% or more debt to GDP defaulted on their sovereign debt, most often via a sustained period of high inflation. And so once we got there after COVID, there's really three ways out. Some sort of productivity miracle. Basically, we invent and commercialize nuclear fusion, roll it out, everyone has it, energy's free, we all live happily ever after. Okay, that's option one. Option number two is we go to 70 million baby boomers and one way or another reform entitlements drastically. We take that 2.9 trillion a year we're spending in cash out the door and we slash that to, I don't know, $1 trillion. Or we slash defense spending. We can't cut rates for obvious reasons, right? It's basically try to get that the spending down. And even then, because U.S. government is 25% of GDP, cutting spending is counterproductive, actually. You'll actually shrink GDP. Your deficits will actually rise, not fall. It won't work either. The last option is you let inflation run hot. You have the Fed pin yields so that real interest rates stay at negative double digits for 3 to 5 years. And you take that 130% debt to GDP down to, we've estimated 70 to 80% debt to GDP. And then the Fed can normalize rates, normalize policy without blowing things up in the way that empirically we have now seen they have blown it up. We've had the worst combination stock market, bond market on record this year, which is what you get when you try to tighten too fast into a highly leveraged system. So that's the happy outcome, unfortunately.
Well, who feels like a drink? Luke, I appreciate your take. I wish I was almost going to revert to podcasting and say I'll put it in the show notes, but I think we're going to have to follow up with that specific podcast link for folks who want to follow along and listen to the 2-hour dissertation versus the 20-minute version. But I've personally learned a lot from you the last 6 months since I became really familiar with your work, and I think you've been on the pulse so far. So I'm thrilled you were able to join us. And I think the moral of this story and the punchline for this is buy Bitcoin, wear a helmet.
I think it's right. Well, manage your leverage and just understand, where we're going to go. But between here and there, it's possible there's a bit of a valley. So buy Bitcoin, wear a helmet. I like that. Yeah.
Luke, thank you very much for joining us. And next year we'll get you here in person and you can take your victory lap.
From your lips to God's ears. Thanks for having me, Ryan. It's great to be here.
All right. Thank you.